Hi, everybody. How's everybody doing today? I would like to provide you with some good information today, and let's get right to it. As a matter of fact, the topic here is long-term trading from A to Z. And you should see a slide there. Here's what we're going to talk about. I'm going to do a quick little bonus talk on news, first of all. If you can spare me 5, 6, 7 minutes. It's an educational topic. It just is something that is kind of near and dear to my heart and something that I think prevents a lot of people from being successful. And when I say successful, I'm talking about people who are managing their own funds, long term or trading shorter term. I think this is something that greatly distracts from them. And we had great examples of it the last couple of weeks. So I want to just take 5, 6, 7 minutes to go over that. I want to give you a couple of quick introductory comments because the last time I was here, I've been here 2 times before in the last 4 months. And by the way, thank you, Renee, and Investor Inspiration for inviting me here. Always a pleasure to be here with you guys. But when I was here before, everybody loved my presentation. I got a lot of comments and emails about it, but they criticized me for not really saying who I am and what I do. So I will take a minute and just introduce myself a little bit better and tell you what it is that I do. But mostly here today, I'm here to try and give you some good information about understanding. A lot of you are probably awfully good investors, but I want to give you some thoughts for those of you that are newer and maybe some tips for those of you that have been around a while that maybe you can take and use to your advantage. So we're going to take this third thing here and go over long-term trading concepts. All right, the value in news. When I talk about news, I always get a little squeamish because I know exactly what it's worth, and a lot of people probably agree with me right out of the gates, and there's people that don't, and the people that don't probably think I'm a little silly to talk this way. But have you ever, guys, listened to the news and yet really fail to really make a connection? In other words, if you ever tried to trade by understanding the news or invest by understanding the news and feel like you're missing something, is that ever, any of you feel that way? Because I know a lot of times, it's a real question. Do some of you feel that way? Because I know a lot of times there's people that they get a certain gut feeling about something, but they don't really realize it until somebody says it to them. The value of news is absolutely none. There's virtually no value to news. Now, I do a more extended talk about this. It's in something called Introduction to Mastering Technical Analysis, which is a free seminar I put on for everybody. It's a half-day seminar. It's coming up June 15th. If I type here, no, you guys, I can't type there. Questions. Nope, that's not going there. Excuse me, just 1 second. My apologies. Oh, here, entire audience. Here we go. You guys, did you guys see test come up? Could you tell me real quick? Yeah, all right, thank you very much. All right. Okay, so there is a link to my website calendar, and next Friday, if you just become a free member, it's no big deal, just give an email, and you will get invited to that, and it's a good half-day seminar. And I talk more about that there. I don't want to take the time here, but I just want to give you some examples of why news can be very detrimental to look at, unless you have some really, really specialized knowledge. And I'm talking about like 1 in 10,000 people. But if you're going on the internet and reading the same stories and listening to the same stuff that everyone else is, you just don't have any kind of edge. It used to be years ago, 20, 30 years ago, that news and information was everything. Today, it's nothing because it's so overabundant. Filtering through the news is what's important. I want to give you an example. Monday, 10 o'clock, this week, and this is why I'm doing this, manufacturing data came out, 10 o'clock. Any of you around for the market and hear that? Terrible numbers, bad numbers. Some comments, you complain about rising prices, raw materials, especially for steel. The Trump administration in March announced tariffs, tariffs again, terrible. So what do you do with that news? Well, this is bad news, right? And the market initially dropped a few cents. Well, if the market would have dropped this day, at the end of the day, think about it, what would the news stories say? All the news pundits, what would they say? They'd say that their market dropped today because factory orders were very bad numbers, right? And you, as an investor or trader, especially if you're newer, you would hear this news and you would say, factory orders, very important because the market reacted and dropped to them today, right? The pundits have to explain why things happen. But prices react to supply and demand, and the news simply tries to justify it. What really happened this day? Well, there, you see that arrow? That's the news announcement. That's the bad news. Now, I especially was called to my attention because somebody in my trading room, typed it out there. Oh no, bad numbers, bad manufacturing numbers. And again, it just simply doesn't matter. There's always a knee-jerk reaction, but the news like this and all these types of things, all these economic reports, they just don't really matter, especially not in some big extended way, in some big broad concept. Of course, you're going to say that if things are going well, the market should go higher. But even that is questionable. We had the biggest market increase during some of the most difficult economic times we've ever had. I'm talking about going back, from about 9 to 2 years ago. We had some of the worst economic numbers we've had, and yet the market doubled, tripled, quadrupled during that time. Also, what was the reason? Well, what happened at the end of that day, and this is what really caught my attention and thought, hey, I got to tell this to these people I'm talking to on Thursday because what a great example it is. Well, at the end of the day, what did the news have to say? The only economic report comes out, it's really bad news, and the market went up that day. What did they say? So what they said was, well, the job numbers were so good on Friday, it carried over to Monday. Really? That's the reason. By the way, you guys can feel free to laugh or type or ask questions or whatever. I mean, I think this is hysterical when you see this, and some of you are probably laughing along with me, and you understand this, and some of you are maybe scratching your head hopefully and saying, yeah, I've been wondering about this, and now that you're saying it, you're right. Yeah, it is. It's noise, but I think there's also, Thomas, I think there's three groups of people to me always. There's people that just totally agree with me. They've been around, they understand, they see this is just garbage. There's people that are new and are still trying to filter through, what does this mean? Do I look at news? Do I not look at news? But there are some people that I would call closet news people. Like they'll stand up and say, oh yeah, the news doesn't matter, but yet they're reading every bit of news and they're trying to factor it into their trading. And what really cracked me up was they said, well, the job numbers are so good. A couple of job numbers back, do you remember, Thomas? The job numbers are so good that, quote unquote, the market dropped because the job numbers are now going to promote interest rate hikes, right? So it's always the same. The market does what it does. And then at the end of the day, the pundits look at the news stories and they say, okay, the market dropped today. What's the story that made it drop? And here it is. College softball tour bus ran out of gas. It just doesn't matter what it is. So anyways, that was my quick little bonus section I wanted to give you here real quick, and I took 6 minutes doing that. I hope you thought it was worthwhile. But another quick thing. Do you remember on the 30th the terrible, terrible news? I heard news people saying that, this will start our market crash. What was it? Italy economic crisis. Where did that happen again? Certainly the economic crisis in Italy is reason to stand aside until the smoke clears. That's what somebody said. Where is the Italy economic crisis? You see it right there? If you squint your eyes and look really close, that was the Italy economic crisis. That's an hourly chart, by the way. You don't even see it on the daily chart. So again, if you decide to stand clear until react, well, now is it safe to get back in the market? You see, one of the problems is that people managing for themselves frequently miss the biggest moves. They frequently miss the biggest moves. And a good example, is the market going into January, February of this year. The pundits, the smart people, the people that tell you what to do, they've been saying to get out of the market for 2 to 3 years. That we're at a top, that we can't go any higher. I hear commercials, when I drive around in my car. For years, I've been hearing them. You got to get into gold, you got to get into silver. The market's on the verge of collapsing. And if you would have listened to them, you would have missed a triple in the market since they started saying it's time to get out. And of course, with the presidential election, you got to get out, and Trump's in office, you got to get out, and tariffs and embargoes, you got to get out, you got to get out, you got to get out. And what has happened? The market has been on a nonstop tear. Hi, my name is Paul Lang. I have been an investor, coach, mentor for many years, at this point more than I'd like to admit. And after many years of being in the industry, I started my own company just last August. And I don't even want to call it a company. It's just me having fun, teaching people all that I know. And there's just three things that I do. It's been great. It's been fun. I'm reading the screen here now. It's just me, so I can dedicate myself to helping people learn long-term and short-term investing, trading. I'm here to give you some concepts about long-term trading, investing if you like. You may know many of these and some will likely be new to you. Sounds like the financial planner I just fired. Not a financial player. I am a 100% technical person and am doing this for a long time. And I've had a nice following of people. I don't, it doesn't matter a whole lot to me who wants to follow along, but I'll show you in a minute. There's three things that I do for people. What do I do right now? I have a commitment to help traders succeed, and it's really what it is. Okay, kept on telling you to wait, you mean? You mean for the market? To get in? Oh, yeah. Okay, I'm sorry. I thought you were talking about me. I got you. Yes, right, exactly. And well, one of the statistics, now I don't want to get off track, but one of the statistics that backs it up, your financial planner and whoever else, but do you realize that 93% of the mutual funds lag the market? I used to quote that as being 85%, and recently I looked it up, and there's a new study done by Standard & Poor's. Do you realize that, guys, 93% of the mutual funds lag the market? They do worse when the market falls, and they do worse when the market rallies. Amazing, isn't it? If you would just go out and buy the SPY, if you ever wanted to be long the market, you do better than 93% of the of the mutual funds out there. So anyways, a commitment to help traders succeed. I am not a big company. I am me. I don't have to sell stuff like crazy to people. I'm just out trying to help people all that I can. I enjoy that. I've been a long time in the industry. I know how to teach people because I've been through it myself, and I've done it for a lot of people. I privately mentor 99 people. I've been involved with other companies, helping both in trading rooms and in terms of writing long-term position letters. And an important thing to me is I talk people out of doing stuff. If you go to my website, and again, it's disciplinedtradingstrategies.com. If you go there at the bottom, you'll enjoy reading the bottom part. There's a thing called a warning. And if you want to get a little feel for me of what I'm like, go and even do it while I'm talking if you get bored listening to me. Down at the bottom, it says warning. Read that. I encourage people to not try to get involved with the market too quickly, to not quit jobs to get into the market, to trade, but rather to learn it slowly and properly and to be smart about what you do. And since I know a lot of people aren't ready to do that, I encourage and try and find ways for people to slowly work into it. And I give a lot of free information in my site. You can, number one, you can go right now to the free stuff page, and on there are play of the week videos, educational recordings of prior events, educational recordings on various topics, trading tools, educational articles, all kinds of stuff that you can go there right now. Just go there now and just get all kinds of free stuff. And it's all good educational stuff. There's nothing like salesy or anything. It's just simply good educational stuff. There's articles that you can read and download, whatever you want to do. And in addition, when you go to the home page, you can click right on there, or I'll type it in here too. If you sign up to become a member, you'll get these additional benefits. You get invited to educational events I do, which I do usually 1 or 2 every month. You get a weekly market summary. You get play of the week videos delivered to you, other educational emails, and you don't even have to give your name. Just give your email. It's all. Just want to get some information to you. That's all there is. There's no credit cards. It takes you 6 seconds. So feel free to do that. And that's what I'm all about. If eventually you do want to learn, there's 3 things that I do, and this is what I have frustrated people with because it's not clear to them. I think it's clear. But if you want to get fish, I run a day trading room during the day. We work about 3 hours a day, a day trading room during the day, and you can go to the site and read about it. I don't want to talk to you about it. Letters, I put out a daily market letter that's mostly for day traders and a long-term position letter. I did it for years. I just started up in my company about 6 weeks ago, and it's kind of the focus of what I want to talk about today is how this long-term position trader works, how you can start a portfolio right now with extremely limited risk. And we're going to get to that in just a minute. So those are how you get fish. And if you want to learn how to fish, you want to learn how to do this stuff, I have a seminar program that I teach that is barring on the best thing you'll ever do. because there is just a price for it. It's a commitment. You take the seminars over and over again. There's other events that we have, and you have my commitment to get you to learn how to do this. So you can read about that more on the services page. If you're on the website, you'll find the stuff. Let's get going. Long-term trading. 13 minutes past the hour, and I did some talk on news, so I think we're on a good schedule here. Let's start with this. Here's how you long-term trade. Decide when the market is at a low. That's step number one. Step number two, take all of your money and put it into the market. And then number three, hope that you've caught the bottom. And if you didn't catch the bottom, add some more positions as the market drops. How does that sound for a game plan? Some comments? Real question. How does that sound for a game plan? You're nuts, exactly, right? You're laughing. It's exactly what you should be doing. But you know what? Be honest. This is what most people do, right? This is most people's idea in one way or another. Now, I had a guy one time that he went broke trying to, and this, of course, let me make it clear. This is a joke. It's not what you do. It's the exact opposite of what you do. But people get fooled sometimes. Sometimes people do this and they don't really realize it. Right? They feel like you ever feel like you're missing the market? You ever feel like, oh my gosh, it's moving up? Well, the one gentleman obviously did, because he said he missed the whole thing because of his financial planner, because he's waiting. If you ever felt like you missed the market and then you feel like you have to get in and make up for lost time, this is the problem that people run into. And going about it this way is what is hurt a lot of people. And this feeling that you're missing and you have to get in and you have to jump in with all your money. This is not what you do. It's not what you ever do. I had a guy one time that pretty much went broke trying to invest his money in swing trade. And this is a long time ago during a very bearish time in the market. And he said to me, I did not average down. He said, I bought Intel, and when prices dropped and things looked like they were really a bargain, I bought Microsoft. And when prices dropped more and things looked like really a bargain, I bought Adobe. You get the point? I mean, he just kept buying tech stocks. And it was at a time where they basically never came back or didn't come back in any time period that kept him solvent. So you have to be a lot smarter in this. Now, I don't have time today to go through all the concepts of money management, all this, and most of you probably know a lot of them. But I do want to go over a way that you can begin investing long-term in the market or begin adding to positions. And again, you all may be in different spots. I have advocated, now naturally there's some positions you may not be able to get rid of because they're in certain types of IRAs or whatever, but I have advocated going into the end of the year that people should basically be divested of anything that is a long-term position that they want to that they don't plan on holding on to forever. There's some stuff you may hold on to forever, I get that, but anything that you're planning on exiting at some point, and I was a couple months early, but I said going into the end of the year, you should be out of those positions, and then we go to a little different process of taking it kind of on a week-by-week basis because of the top that we kind of hit. So whether you're starting over or looking to add some things back in, what's the right time to do it? Well, any time is. What I just described is wrong, because even people who are great market analysts cannot have the accuracy to go all in most of the time. Sometimes you can. Sometimes the chart patterns give us just a wow, thank you. But there are so many times, like there have been several instances over the last few years where there was not a clear spot to say, okay, time to start adding more positions. It was just difficult. We'll talk more about market analysis in the moment, but for now, let's just pretend you don't have a clue. Not today, not ever. Let's just say we don't really know. Is this the market top? Is it not the market top? That, of course, is one of the questions everybody's asking today and what you're going to want to hear from me, which I'll talk about. But for the moment, let's just say we don't know what's going on. How do you go about investing intelligently and not being able to say, yes, this is the top, yes, this is the bottom? I want to show you that in just a minute. First of all, if you want a long-term plan, if you're young, like under 30, wait for the next crash. I wouldn't start now. I don't know if we're going to start pulling back in 6 months or 3 years. I'll talk more about the market in a minute, so don't worry about that comment. But wait for the next big crash and then start dollar cost averaging in. And it doesn't even matter what you buy. Again, if you're under 30, my recommendation, very simple, wait for the crash. When is the crash coming? Well, even if you don't understand the market, wait until you hear the people on TV saying, we can never get back in the stock market. You can never trust the stock market. This is it. The stock market is over. Nobody will ever buy the stock market again. Everybody's been hurt. This is the last time. When you start hearing that on the news, that's the bottom. And that's when you start dollar cost averaging. And what you do is every month you take X dollars, you put it in the market. It doesn't matter. I don't care what you do. Buy an ETF, buy the SPY, buy a mutual fund. Just keep putting it in every month once the market crashes. And over years, and again, I'm saying you're under 30, over years, you will do fantastically well. That's a good bet. And it's even coming from somebody who's about to tell you later that there is a certain pattern that may develop that if we go significantly higher again and then hit a market top, we may see the biggest crash we've ever seen. But, might I digress? Let's talk about that in a minute. So, bottom line here, it's great to be young. If you're young, it's really all you have to worry about. But what if you're not that young? What if you have to worry about retiring in the next 20, 25, 10 years or whatever, and you don't have the luxury of saying, gee, 5 years until the crash, and then we crash, and it's 10 years before the market recovers. I mean, that's not going to work for me. So what do? Well, we have to be more vigilant, not aggressive, because as you've probably heard your financial planners tell you, as you get older, you need to be less aggressive. Well, it depends how you interpret the words, because the truth of it is it's kind of backwards in a sense. I mean, you can be more aggressive when you're young because you have time to make up for mistakes, but you don't need to be. When you're young, you have time on your side, and you just start socking it away. When you're older, you can't necessarily wait years to start what you want to do. So how do you go about doing this? Can you start now, even in this market? The answer is sure, you can. How do you go about doing this? Here's how you do it. And again, as you get to know me a little bit, I'm kind of a no BS person. I'm not sitting here's the formula right here. I'll gladly share it with you because this is only part of the secret. Part of the secret is you have to know what to pick and exactly when to do it. But here's how you do it. Decide on how much you're going to risk on a single position. Now, this is critical. There's no other way to do this. All this garbage, I don't want to hear about, well, when a stock drops 10%, you get out, and Investors Business Daily, and none of that stuff is proper. That's for people who do not have a clue what a chart is or how to read a chart or how to invest properly. You don't wait for something to drop 10% and then get out. That's not what you do. And you don't take unlimited losses on something because you bought a ton of those shares. What you do is you decide how much money you're going to risk on a position. In other words, if that position stops out, if it reaches a point that you no longer want to live with it, you're going to lose X, $1,000, $500, whatever that is for you, based on your portfolio. Everybody okay? Can everybody understand me okay? And I'm going slow enough, and or you're still awake? Just a little quick check here. We're good? All right. The number two, you study charts to find a position. I started many years ago, and I started the same way a lot of you did, saying, hey, show me the fundamentals, let me listen to the news, and it took me 6 months to realize that there's only one thing that you can look at, and that's technical analysis. So you study the charts to find a position, okay? While we don't have perfect market time, we want to go long on market pullbacks and uptrends. Pick relative strength stocks, and this is what gives you a bumper. Now, what do I mean by all that? Okay. You can't try to be perfect when you go to start a position in terms of saying, gee, I have to find the perfect day the market hits its relative bottom here. Okay, that's just not going to happen. I can't do that on most occasions. I can sometimes. Sometimes the charts let you do it, but sometimes they just keep going or they pull back more than you think. So what we're going to do is we're going to keep a watch list in front of us. We're going to look at those weekly charts, monthly charts, daily charts, and we're going to have some stocks that are interesting to us. And again, I hope you understand, it's not my goal. It takes me about 3 days to explain to people how to read a chart, so that's not the goal here. But you all probably have your method or system you do. You want to find charts that are interesting to you, and let's keep it on the bullish side for the moment. So you look for bullish charts, and then when the market hits a spot, and you don't have to be perfect at this, you feel that this is kind of the pullback area, this is kind of the weak spot, and it's usually when you're scared. It's usually like when you're, oh my gosh, the market may not hold here. That's the time you want to look at getting in your bullish position. And you want to do it, and again, you want to pick an entry criteria for your stock because your stock is going to be something that's relatively strong, it's in a proper area, and it does something that impresses you, that gives you an entry requirement. In other words, it has the ability to trade above some area it hasn't been able to. And again, this is where what I'm saying this last minute is hours of understanding. But whatever you use to pick stocks, this is how you want to do it. I want to just kind of give you the formula how to do this with almost no risk. Now, I say it gives you a bumper. What do I mean by that? Well, let's say you go long the market. And I can't draw in here, can I? No. Let's say you go along the market and you think you're at the bottom, you go along the market, and it takes one more little hitch lower and you get knocked out of your position, right? What happens almost always after you get knocked out of your position? Then it really goes higher, right? Well, by a bumper, I mean that you have a stock that has relative strength, and maybe if you didn't quite get the market in the right spot, maybe your stock hangs on because it has some relative strength, because it has a different chart pattern, because it's just been being bought by people, and it doesn't falter on a few days when the market suffers. Does that make sense, everyone? So it gives you that little added edge, all right? So as the market moves in your direction, as the stock moves in your direction, what we're going to do is we're going to sell a third of that position, maybe a half, depending upon where you are in the world. And that is going to allow that position to stay safe. In other words, if you sell a third of the position and somewhere along the way, maybe there's a spot that you're able to raise your stop, or even if you don't raise your stop, if you sell half the position, the trade can't lose money anymore. The position can't lose money. It's a safe position. Now, I put asterisks by that because when you're holding positions overnight and when you're long-term trading, naturally there's a thing called gaps. Stocks could all of a sudden gap down, and they could theoretically still go beyond your stop loss. But we all know that's a fact that can happen. But aside from that, if you let that concept go, you will be safe, meaning that you could now add another position and only have that one risk unit of risk, the $1,000 or whatever it is that you're risking. So you continue to do this. Now also, since one risk unit is probably very little risk for most people, since it's probably going to be a small percentage of your account, perhaps you want to start off with 2 positions or get in a second or a third one fairly quickly. And then as these positions go in your direction, you pick a spot on the chart that you sell part of the position. This gets these positions safe, and once you're safe and you're at zero risk, or ideally you're in a spot where even if your positions stop out, you've made money on them, you then can continue to add more positions. And every time the market rallies up, you're selling the thirds. Every time it pulls back, you look to buy another position. If the market does not continue to go up, you will automatically be stopped from buying more things the next time that you hit an area where it stops, because you won't be able to anymore. And you'll never have more than that small risk. So if the market all of a sudden a week from now, you know, whoever, North Korea launches a nuke and hits Hawaii, whatever it is, and the market tanks, you are going to have extremely limited risk, because if you've been doing this for a year, maybe you have 20 positions and you've made a ton of money, but the open exposure you have is always going to be positive or zero or negative, just a very small amount. And we continue to do this, and we do it, you know, all the way up or all the way down. Example, this is the QQQ. I have a chart of the SPY too. I look at both the QQQ and the SPY. The QQQ, of course, is the ETF for the NASDAQ 100, and the SPY is the acronym, or is the ETF for the S&P 500. And for bigger term market analysis, I also look at the small cap index, the Russell 2000, which, as most of you probably know, is at new highs. And these are the little dips we're talking about. Hopefully you can see my arrow on here, but this first blue arrow, you know, this dip, when you get this big green bar coming off of here, you say, okay, let's hit a position, a stock. Now, people typically ask, well, can you just do the market? Sure, you can do, maybe you take, you know, a third of the money you're going to take for your long-term positions, and maybe if you like the spot in the market, you take a market position. That's okay too. I wouldn't do it with all of it though, because again, if you're wrong, if you're off a little bit, then you end up stopping out and missing moves. See, nobody is good enough to be constantly all in and all out. The most professional people in the world, professional market makers, they're the exact opposite of that. They're constantly buy, sell. Now we can't do it that often, But we need to get out of the habit of thinking we're all in, all out, and either we kill it or we get killed, because most of the time people get killed rather than kill it. So we take a stock, market rallies, boom, boom, boom. We took a couple positions. We saw a half, we saw a third, boom, boom, boom. We're safe. We have nothing at risk. The market pulls back, say, hey, you know what? My stock's held. I still have these positions. They're back halves, and here we're starting to go up again. So boom, another position, another two positions, another position, whatever it is, and we keep doing that all the way up. And over the years in an uptrend, you will continue to do that with just the occasional hitch that'll come. And that hitch may have you trail out of some positions, but it doesn't matter. You just keep the process going. And whenever you get to a new buy area, you buy. And if the market doesn't ever get to a buy, and again, understanding technical analysis, you have to know what that means, you're not going to be adding. Okay? You hang on to those back halves or back 2/3 until larger targets are reached. You just keep adding as long as your long-term account. And if you keep doing this in a trend market, you'll build into a large portfolio virtually risk-free. So I wasn't going to do this with my new company, but I had a lot of requests to do this because I used to run a long-term letter. So I started one up 6 weeks ago. And it's exactly what I'm doing. And I decided to do it partly because since I was devoid, I wanted to start it myself again. And I just figured, fine, I'll just put this letter out and we'll just do it. So here is the first position. And coming here off of the low in May, where's the market? When the market hit this low right here, I started this letter in mid-April. So we waited for this pullback. And it's exactly what I'm telling you. When the market came off this low, that's the market. Here's Tyson. It took Tyson as it came over this daily red bar. Is actually an interesting hourly chart, whatever, but it took Tyson right in here. Now, this chart looks terrible to you, I understand, because it's a daily chart, but this was a beautiful monthly chart. This is a beautiful monthly buy setup. Tyson ran up over a period of time. It hit target number 1, sold target number 1, and then today the stop was raised to this area right in here. You can see my arrow, I hope. So Tyson is now safe position. In other words, if Tyson were to fall and stop out, I am not down money at all. It'd be up a little bit. I have Tyson's real close call. I'll be really close to break even. Okay, I did that with another position, MAS. MAS's stop is up. I don't have the chart here. And then because of where we are in the market, where we just recently moved up here, I started a third position, or at least put out the buy for a third position right now. So this is how you can go about doing this. Now, what about this market per se? Before you even ask, I know it's a question that always comes up. These scales are what I put on both the long-term trader letter and on the daily market letter. And of course, for the big picture, this is the one we care about, long-term outlook. Now, long-term outlook means the big picture. You know, like the one, like, you know, do I dump everything I have? That has been pinned maximum bullish for me for 9.5 years. It's never been off that number, never. And there's people, this is recorded, it's going to be around. There's people that follow me for years and years and years. You know, they would scream at me if I was lying to you. And by the way, I am by nature a bearish person. You may not get that listening to me right now. Meaning, I follow the charts, whatever way they tell me to go, but in my gut, I'd rather be bearish. I think all this market bullishness like this is crazy. But you have to follow what's happening. And this is what's happening. And I've been bullish for 9.5 years. Nonstop, honest truth. Now, the midterm outlook, that's over the next few days. That will change from time to time. We hit short-term tops. This will change to bearish. And of course, the intraday outlook, that's for day trading. That changes every day, basically. All right. So where are we right now? Well, I have never changed this from being max bearish. However, for the first time in 9.5 years, there is a question that has to be asked. I am still going to stay bullish in the big picture, but this is the SPY right now in the weekly chart. This is the S&P 500. It is more bearish than the QQQ. The QQQ is up here at all-time highs. It just broke all-time highs today, or yesterday, or whenever. We have to acknowledge the fact that we may be in a sideways pattern for a while. And if that's the case, how do you handle this? Well, here's how I'm going to handle it, is right in this area, as we start pushing this area, and as soon as we see a bearish occurrence on the charts, now that we're at these highs, I am going to try to add a bearish position to the portfolio, a short position to the portfolio, so that when we're hitting the bottom of this range, we're going long. We're selling 2/3 as we get up here. And this way, see what's happening here is that if I'm wrong about being short at the top, I still have the bullish positions. The management of them is not going to change. And as long as they're holding their comfort zones, that's great. And if we start, it's very possible, what happens sometimes, I've done this a long time, is that you can end up with both bullish and bearish positions and they're both working because you pick stocks properly. There are stocks that are inherently weak or whatever they are, and they begin to drop. And they drop even when the market's still kind of strong, going sideways, whatever it is. So this way you're kind of catching the best of all worlds. Now, it involves being a good chart reader. You have to understand what is bullish, what is bearish, what to short, when to go long. But this is the procedure that you follow. And as a long-term trader, if you don't want to spend a lot of time, for the most part, I'm talking about looking at weekly charts. I'm talking about working on the weekend for an hour and maybe spending a few minutes in the evening, a few evenings a week to manage this type of thing. So not hard to do. One more question left then, I think. What do you do if you're stuck sideways? Well, as I just said, if you can just decide that we're at the top now. You could take additional profits on your long, take those second thirds, and just lay low until we see what happens. That's one thing you can do. Depending on your skill and tolerance, you can find short positions. That's what I just talked about. Again, you want to get that bumper working for you. In other words, I want to take a certain type of stock short that may still drop even if the market keeps going higher. That's what I want to do. And here's the big question too that comes up. What do you short? Well, do you short if the market comes into a top like we're hitting kind of right now and you want to short something, do you short the super weak or do you short the super strong? What do you go after? Anybody want to take a guess? Anybody want to take a guess? I have about 10 minutes left here, and this is my last slide. What do you go after? What do you think? Because I have some definite advice for you here from something that I've just known for years that's not real commonly understood, that I don't think a lot of people always get. Weakest sector, that's not a bad answer, Fitz, that's not a bad answer. Looking at the sectors that are not doing well. But the interesting thing is you do not want to short the weakest things out there. See, a lot of people think, okay, the market's railing, it's way up here. And naturally, of course, we're talking about something that's weak. We're talking about a market type stop this week. Naturally, there are stocks that don't follow the market. Gold, oil, silver, some of these things are inherently kind of the opposite of the market or do on their own thing. But if you find a Qualcomm or an MChip, a tech stock that's making new lows while the market's making new highs, is this what you want to go after? And the answer is no, believe it or not, it's not. Because the funny thing that happens is if you're truly in a bullish market and you're staying in somewhat of a bullish market, is when things get overbought, the overbought things get sold, and guess what? The money goes and picks up those really cheap things initially. And you'll find great frustration trying to short the extremely weak. What you need to actually find is going to be hard for me to explain here right now, but I can show it to you. If you, on every other Monday, I do a free chart scanning session, and this question typically comes up. And what is today? It's going to be next Monday. So again, if you go to the calendar, and if you're a member, you will get an invite to a bi-weekly scanning session where I'll show you examples of this. I can't go through all this. Yeah, thanks, Andres. So there are a certain type of pattern you want to look for if you want to go shorting stocks when you think we're at a relative top. Now, understand what I'm saying. You never just short a strong market. You never short stocks that are in regular uptrends. You never guess the top. That's the worst thing you can do. People have been guessing the top for multiple years, and they're wrong every time. But there's an intelligent way to go about handling the market when it hits areas that could be stopping points for it. And that's what you have to do. Joe, you hit that amazingly accurately. Joe has the answer there. I think you're at my you're Joe. You're at my Monday night thing. That's exactly right though. We're gonna find stocks that have been strong, but this last rally they tailed off when they started showing weakness. They're getting the first signs of selling, so they have good areas to drop. But I have to show you the chart pattern though, because there's a fine line between a stock that's just lagging a little bit and a stock that is truly getting selling. So you have to notice the difference between those. But you're absolutely right. So I have 6 minutes left, and that is my presentation. So I hope you enjoyed it, and I hope you got some things out of it. If you're here because you're interested in investing for yourself or trading for yourself or doing some of both. By the way, the long-term trader letter that I put out, that is a subscription, that is something you do pay for. I decided when I put it out that I would allow people to have full-time access to the day trading room for no extra charge. And the reason that I do that is because I don't want, there's a lot of people who have some days every month, but not enough time that they would subscribe to the room because you got to pay money for that. So I figured, hey, start to learn slowly. You know, I hate it when somebody says, gee, I'm quitting my job next month, I got to learn how to day trade. No, that is not what you do. It takes longer than that. Again, read my warning on the webpage. So what I thought would be a great thing for everyone is, hey, you're subscribing to the long-term letter. That's how you're making your money. You work as a consultant, you do this, you do that. You have a couple days, a day a week, couple days every 3-4 days a month. If you subscribe to the letter, you get unlimited access to the trading room for free, just because I think that's the right thing to do. So you don't pay twice. You'll see that I don't like to charge the opposite of the big business concept. When somebody's a client of mine, I try and take care of them, not see if I can charge them again. Everybody who's a member of the room got the letter free when I started because I didn't want to tell them, hey, you got to pay for this. So that's just the way it is. Does your methodology work for futures? No. Yeah, great question, Gene. Learning, I call it my personal little thing, my Paul thing at Disciplined Trading Strategies is I teach the language of charts. You know, that's my little, put on the Coke bottle phrase. But technical analysis is technical analysis. There's different time frames, but Gene, it does not matter what you're looking at. And don't let people tell you it does. That's used to sell additional classes. I hate to say it, but it is. How do I know? Because I've been with the big companies, and that's what happens. Oh, you got to take the Forex class now. Oh, you got to take the futures. And no, it's all the same crap. It's all the same stuff. Yes, I mean, currencies go in pips, and futures are open 24 hours, and but the difference is you can learn just going on the internet. What is the art that you have to learn, and I call it an art because it is part art, is understanding, reading the language of charts. It's doable, but once you know it, it works for the market, it works for futures, it works for commodities, it works for Forex, it works for anything that trades with volume. Okay, Gene? Period. Well, but Forex uses a special moving average. There's no such thing as a special moving average. There's no such thing as a special indicator. It's all crap. I like moving averages, but there's nothing magical about them. And no, you don't change them because you're looking at this or you're looking at that. Doesn't matter what you put on there. You want to use exponential? Who cares? Go ahead and use exponential. You want to use a 14 simple, a 19x? Go ahead. Use whatever you want. It really doesn't matter. Just get used to reading your chart the way it is. Okay? That's a great question. Does anybody else have a question like that? Or a silly question. I'll give you like 20 seconds here, and then if we're done, I will just end a little early. Feel free to email me. I've invited people, even if you're not a subscriber, or even if you're not a member. If you want to email me some charts or trade you did and ask me my opinion, feel free. I gladly do that for people to try and get your point in the right direction. Bitcoin, same thing. Bitcoin doesn't matter. Now, here's the thing. Here's the funny thing about Bitcoin that cracks me up. If you think Bitcoin is a great thing, and you think Bitcoin is going to blow, and you want it as an investment, just go buy the damn Bitcoin and put it away and stop talking about it, right? Correct? That may be a great thing. I happen to think Bitcoin will take off. I really don't know. That's like saying I don't like Buffalo Wild Wings or I love Walgreens. It's just, okay, I think it'll take off. But if that's what you want to do, go put it away and forget about it. But if you want to trade Bitcoin on a day-to-day basis, well, it's no different than anything else other than this huge volatility. And you can trade Bitcoin, you can trade the S&P futures, you can trade Qualcomm. Doesn't really matter. It's a chart, it moves, you capture movement. There's plenty of volatility in the stock market to do anything you want to do. So, it simply doesn't matter. Long term, you like it, that's just a judgment call, put it away. Trading it, do whatever you want to do. Is it possible to accurately read who is on the opposite side of the trade and their current strategy and to use mechanical stops? Paul, who's on the other side of the trade? No, you don't know. Other than a generic concept, Paul, like is it big money or whatever? But I mean, in a bigger picture, yeah, that's what our quest is, Paul, as a technical reader, is to see the footprints of big money, we call it. Where's the big money coming in? And yes, you can tell, and you can tell by who's winning the battles time and time again. Bulls come in, bears come in, a battle is fought, a battle is won. And when that consistently happens, we look for these key inflection points, and that's what helps tell us. And that tells you that you're on the side of big money. But I mean, on any individual, trade or whatever, no, we don't know, and we care about any individual trade. We care about the result of every battle, okay? To use mechanical stops, I think stops are one of the most important things about trading and one of the biggest ways you can lose money. And you can lose money by incorrectly following your stops, I hate to say. And again, this is one of the things I teach in my classes. I don't want to say, oh, gee, here's a class you have to take. But I spend about a half a day talking about the importance of stops and how to manage a stop. You do have to, Sally, you do have to have somewhere a protective stop put in that's guaranteed to go off so you don't go crazy and lose your money. But the way most people use them and the places that they put them will cost you money and make you lose money. Most stops in the short term cost people a lot of money. Now, you have to have them because in the long term, you'll get blown out one day. But on a day-to-day basis, on an average day, most stops are costing people money because you use them the wrong way. And it's a big thing, and it's probably one of the biggest things I changed my own personal trading style 17 years ago. To use other indicators, I use a couple of moving averages as a general guide and volume, Don, and that's it. You saw my chart there? That's my chart. A couple moving averages. Where is it? Those green and red lines I put on there for this presentation, so they're not indicators of any kind. There's 3 moving averages and volume. That's all that I use. I wouldn't yell at you, Don, or scream at you if you had an indicator that you use to negate a trade. That's fine. In other words, to say, I'm not going to take that trade because of that indicator. And also, you need to use indicators to scan. If you have a scanner or you scan through your trading platform, looking for things that are above an upper Bollinger Band or that kind of stuff, it's all great. But if you understand what goes into most indicators, all the information is there in front of you. It actually, and I don't want to say this in an incorrect way, but it's almost silly to look at them when you really understand what they are. Now keep in mind, I'm talking about technical indicators that are those things that look at past price bars to put a new line on the chart, things like MACD and all those things. There are other things that are not technical indicators that do us some value, such as the VIX and some other stuff, even though most people use the VIX terribly wrong as well also. Are your charts set up like when you're... Yes, Don. Hey, Don. How you doing? Don, I actually remember your name. I'm not just making that up. Of course, Don Wilson's a common name, but yes, that concept about looking at charts and what to look at, I haven't changed in years and years and years and years. Yeah, absolutely. Absolutely. Guys, I'm going to have to call it right there because I think I'm out of time and Renee's going to come in and kick me out. But Renee, thank you so much for having me. And, hopefully in a couple of months I'll be back. I hope you guys enjoyed it. And again, feel free to email me. If you go to the website, you'll find my thing. Or it's just simply Paul, P-A-U-L, at disciplinedtradingstrategies.com. I can't type the rest of it. You'll figure it out. All right, guys? Hey, Don, thank you. Thank you. I never liked Buffalo Wild Wings as a restaurant. It was a good stock for a while. All right, guys. Have a great evening. Have a good weekend. Talk to you later, guys. Bye.